Hey traders, excited you guys are here today. Got a good one for you. I want to be going over the 101s of trading. I want this channel to be for everybody, for the intermediate traders, for the beginners, for advanced, for everybody. If you're new and come to the channel, I want you to learn quick so you can be a part of the everyday trading team. So we're going to go over the 101s, market and limit orders, resistance support, public floats, all that good stuff. Going to go over that in this video today, so let's get straight into it. First of all, what is a trader? Well, we're all traders by nature. Some trade a tuition for a degree, some trade their time for a job, for security. Day traders, we just trade risk for money. And what is a day trader? A day trader, we're just hunters of market volatility. That's all there is to it. The thing is, we have to have volatility though. When the market is flatlining, there's no money to be made. But whether the market goes up, whether it goes down, there's opportunity. And we're not paid for our time in the market. We're paid for the opportunity that the market presents, whether that's up or down. And not everybody understands that, but you can short sell. You can go long. There's many different ways to trade the market as long as it's volatile, as long as it's up or down. So we're hunters of that as day traders. And as you get that experience and you're in the market for a while, you'll understand that and you'll really figure out who you are as a trader. You tend to be more long biased or short biased. You'll find out how to trade based on your personality. There's many different ways to trade in the market. There's no one holy grail. There's many different ways to make money. You just have to find the one that works best for you. And while you're finding that out, paper trade. Trade with small amounts of money. Don't risk a lot of capital at first like a lot of people do and then end up blowing up. You want to find out who you are as a trader by finding out who you're not as a trader. Just like Thomas Edison said. He said, I didn't fail 1,000 times. I found 1,000 ways not to make the light bulb. You're going to find out how not to trade so that you can find out how to trade. So let's get into some of the 101s, guys. And first of all, we got to talk about candlestick charting. And I'm going to pop up a picture here. This is candlestick charting. There's a bullish candle and a bearish candle. They're going to be green for bullish and red for bearish. Now, what the green is signifying is the bottom of that body is the open and the top of the body is the close. Now, the upper and lower wicks are where that stock moves in this time frame. Now, you can use a candlestick chart for many different time frames. So this candlestick can represent a 1 minute, 2 minute, 5 minute, 10 minute. It can represent a day or 2 days or 5 days. But we're just going to talk about a 1 minute time frame. So this candlestick represents 1 minute and a day. And what this is telling us is on the green bullish candlestick that it opened right here at the bottom of the body and it closed right there. But the upper and lower wicks, it did touch those areas. It did hit those prices, but it didn't open and close there. And so this was confusing to me at first. It really was. But as time progresses and you see these over and over again, it'll make so much sense to you guys as the years progressed. And the red one, the bearish one, tells us it opened at the top of that candlestick, the top of the body, and then it closed at the bottom of the body. Now it hit a high at the upper wick, it hit a low at the lower wick, but it opened at the top of the body, closed at the bottom of the body. That's candlestick charting, and the reason everybody uses this versus line graphs and all these other types of charting is it tells us the most information. This really reveals to us more information than any other charting out there because it tells us so much more than a line could tell you. It tells you the open, close, and upper and lower wicks of that individual minute. So this is the best charting out there. You need to learn it. You guys will get good at it. So just study it and paper trade with it. Use it and you guys will be good to go. And we could get into advanced candlestick reading. I may save that for a different video, but just understand at first for this video, really study these candlesticks, understand how to read them. A lot of you may already know how to read them. You know, be gracious with the guys who have not figured it out yet, and you guys will. Let's move on to float, the public float of a company. Now, this is very easy to find. A lot of scanners will provide these. If you don't have a scanner, you can go to Yahoo Finance and look under statistics, and each individual ticker has a public float. Now, what is the public float? It is all the shares available to the public. This is different than outstanding shares. Outstanding shares tells us all the shares that are available, not only to the individual investor, but also to the institutional investor and the insiders. It's important to know what the public float is because this tells us price and demand. It tells us, how many shares are available for people to buy and sell. And the lower the public float is, the higher the demand for those shares are going to be, which can cause a larger rip. And we've seen this time and time again. Now, I know it's going to take some time to figure out what floats I should be looking at, or, this float is this, so the stock moves in this way. It takes a little while to figure out, but just understand that the lower the float, the bigger the rip can be because, the higher the demand is going to be for those shares. So oftentimes 5 million shares in the public float and lower is going to be a stock that moves very, very, very quick. Just like this one, DRYS. This one went from about $5 up to $100 in a very short period of time. So they can move very quick. And a lot of chat rooms focus on these types of stocks because like I said, the higher the demand, so they have a lot of people in their chat rooms and they can push these things on up very quickly. They're oftentimes what's traded in the momentum day trading chat rooms. And a word of caution, these can be very risky, they can be very rewarding, but you have to understand proper risk management, I believe, to trade them. Oftentimes many people start day trading by trading these rather than getting more experienced and advanced with some of the higher floats and then trading these. And the reason these stocks can move so fast is because not all of them are very accurately valued. And so a stock like Apple, everybody knows the value of it. But a penny stock, a lower float, something that's like a few million shares in the public float, not many people have heard of it. They come out with huge news. The stock can double and triple its market capitalization overnight, whereas a stock like Apple is not going to double its market cap overnight. And to figure out a stock's market capitalization, all you got to do is multiply the outstanding shares by the price of the stock. And the outstanding shares are going to be, all the shares in the company, not just what's available in the public float. Now, there's a lot of information I'm going to convey to you guys. Watch the video a few times if you have to. You'll get it over time. You will get it over time. Don't worry about it all right now. So that's public float. Just understand that 5 million and less is really tiny. That's like nano cap stocks. And then above that's going to be small cap, then mid cap, large cap, that sort of thing. But just understand what the float does. Higher the float, the less volatile it's going to be, and the lower the float, the more volatile it's going to be. So let's move on to the next topic, which is going to be resistance and support. Now, I'm going to pull up a chart right here that's really going to show you guys what this is talking about. Resistance serves as a ceiling. If you notice from this chart, we got this ticker that has hit the ceiling 3 or 4 times. It's hit that line. That's what resistance is. And support acts as a floor. So these are often areas that traders will look at to be either buying a stock or selling a stock or short selling a stock. These are areas that traders look at. And it really provides us key risk area as well. So for the newer trader, it's really ideal because, okay, this provides us an area for entry. And if it cracks under that level, that's our risk. It gives us clear risk guide on the stock versus, just getting into a stock and not understanding exactly where my risk may be. It's really easy to identify, and that's what really draws in a lot of traders to trading, just resistance and support. And even a ton of advanced traders trade these as well, for quick and easy gains. Just trading off of resistance and support. It's as easy as that. So it's important to understand that resistance and support not only serves for intraday charting, but it serves for daily charting as well. So it's really important to pull up the daily chart. This is something that you guys should focus on, not just the intraday chart. You don't want to just see a stock going straight up and say, okay, let me buy this. You want to take a look at the daily as well to see how this stock, personality is overall. And when it has volume on these days similar to it has on this day, what does it do? How does it react? What's the range of the stock? Range is just, volatility intraday. So you can look at candlesticks, daily candlesticks in the past, and see what this stock has done relative to today. And get a really good feel for the stock. And I always do that. Take a look at the daily chart. So something to keep in mind as well as you're beginning your trading career. Not only to look at the intraday chart, but to pull up the daily chart as well. And lastly, and this is the one I think you guys will probably need to spend some more time on, is going to be level 2 times in sales and market and limit orders. We're going to go over all three of those. I'm going to pull up this chart right here. This is level 2 market data. It gives us an in-depth view of this individual ticker. And these are limit orders that have been placed on the bid and on the ask. So those are limit orders. If you want to buy some shares of this stock, you can place a limit buy and your buy will go on the left side. If you want to go short on the stock, or if you want to sell some shares that you already have, those sell orders you can place on the right side of the stock. So that's what limit orders do. You're pretty much placing your order on the level 2, either on the bid or on the ask side. Now you can place it anywhere you want. You could place it way under the best bid or way under the best ask. I could really get in depth on limit orders as well. There's many different types of orders out there, but for now, I just want you guys to know that limit orders, you're placing your order out there. You're not trying to get it executed right away. You want to wait until the price comes to you, not just jump in there. Now, what is a market order? A market order is exactly the opposite of that. You want to get taken out immediately at the best available price. So when you place a market order out there, you're saying, take me out right now. I don't care, what the price is. Just the best available price is what you're going to get executed at. So if you placed a market order, you're going to immediately hit the ask price, which in this case is $12.20. So you want to buy the stock, you place a market order, take me out right now. It's going to take you out the best available price, which is going to be that top price at $12.20. A limit order would say, I want to get into this at like $12.18. So you place a limit order for $12.18 is where you want to buy it at, and the stock pulls back down to $12.18 and someone hits that order, that's when you'll get taken out. And if they hit that order, it's going to appear in the times and sales window, and that's on the right side. And these are red and green orders. So red is telling us that someone has hit the bid. Someone has sold these shares and hit the bid right there at $12.19. If it appears green, that means someone's buying. They just bought the ask price at that price of $12.20. It's showing up green. Somebody bought those shares straight off the ask price. It can get a lot more convoluted than this. We'll go into more detail in another video. But for now, these are the main things I wanted to go over in this video for you guys, the 101s of trading. So I hope you learned something from this video. It's for beginners. For the new guys that have come in and are trading, don't be discouraged if you're feeling overwhelmed, because that's how all of us were. You're going to get there eventually. Let me know if you guys have any questions at all in the comment section below. Feel free to hit that like button, guys. Hit the subscribe button. We will see you all next time.